Good morning children, welcome back to macroeconomics class. In the previous class we had discussed about the different classifications of good, that is consumption good, capital goods, intermediate goods and also final goods. And also we had discussed about depreciation, stock and flow variables. Today's session we will be discussing about the circular flow of income. What is national income? National income is the money value of all final goods and services produced by a country during a financial year. The factor income also will be calculated there. What is factor income? Factor income means the income coming from the four factors of production. What are four factors of production? That is land, labor, capital, organization. These are the four factors of production. We have to provide remuneration for these four factors of production. So what are the different remunerations we have to provide for factors of production? They are land for rent. Land they will get rent in return. Laborers will get wages for their services. Likewise, for capital they will get interest in return. And finally, the organizations or the enterprises they will get profit, that is the remuneration for enterprises. Profit is the remuneration for enterprises. So these are the different four types of remuneration that we have to provide for factors of production. In the circular flow of income, we are discussing about mainly two sectors. There are furthermore sectors in the economy, but here in this lesson we are discussing only about two sectors, that are firms and households. Children, before studying about the circular flow of income in detail, we can just revise the main points once again which we had discussed earlier. There are two types of payments, or there are two types of income, that are factor payments and non-factor payments. Factor payments also known as factor income, non-factor payments also known as transfer payments or transfer income. What is this factor income? As you know, there are four factors of production, that are land, labor, capital and organization. So whatever income we are getting from these four factors of production are called factor income, or it's an income that can be derived by selling inputs or means of production, that is land, labor, capital and entrepreneur. But at the same time, transfer income refers to any income which a recipient receives without providing any goods and services or assets in return to the payer. That means the payments received in exchange for rendering productive service is called factor income or factor payments, whereas the one received without providing any goods or services in return is called transfer income or transfer payment. What are the remunerations for these four factors of production? Payments in the form of rent, interest, wages and profit. That is, rent is received from land as remuneration, interest is received from capital, wages is received by labor and profit is received by entrepreneur. As I told you before, this transfer income is the income that is received without providing any services or goods in return. How they are getting the income without providing any services? Actually, these transfer payments are providing by the government for the welfare of the people. That is, this government, they are distributing the money to those who are in need. Examples for transfer payments are scholarships to students, unemployment allowances, old age pensions, gifts, grants, etc. So all these are providing by the government for the welfare of people. I hope that you are clear about these two terms, that is factor payments and transfer payments. Now let's move to the topic circular flow of income. Circular flow of income in two-sector model. The two sectors are firms and households. The aggregate consumption by the households of the economy is equal to the aggregate expenditure on goods and services produced by the firms in the economy. When the income is being spent on the goods and services produced by the firms, it takes the form of aggregate expenditure received by the firms. Since the value of expenditure must be equal to the value of goods and services, we can equally measure the aggregate income by calculating the aggregate value of goods and services produced by the firms. When the aggregate revenue received by the firm is paid out to the factors of production, it takes the form of aggregate income. Children, you just watch this explanation about the circular flow of income. It will make you more clear. Children, look at this figure. This figure shows the circular flow of income in two sectors, that is firms and household. Firms are production unit. As we are discussing about the two sectors, we have to consider the factor market and product market. Factor market means it involves four factors of production, that is land, labor, capital and organization. Product market means the place from where we are buying goods and services. These firms providing goods and services to the household. That means the household purchase goods and services from firms. That is real flow. Actually, no money is involved here because they are providing only goods and services. So it is called real flow. For getting these goods and services from firm, this household paying money to the firms. So actually, while providing this money to firms, it will be the expenditure of household. But at the same time, these firms are getting income from household. Same way, the household providing factor services to the firms in the form of land, labor, capital, etc. For getting these factor services from household, these firms has to pay money to the household. So, to conclude, this household will get income from firms. At the same time, for getting the services, firms are providing money to household. So, it will be the expenditure of firms. That's why we are saying this circular flow of income in two sectors of the economy, that is firms and household, are interdependent. That means they depend each other. The circular flow depicts the interdependence or the interrelationships between these two sectors, that is firms and households. Actually, these two sectors, that is firms and households, are depending each other. Actually, the aggregate consumption by the household sector of the economy will be equal to the aggregate expenditure of the goods and services produced by the economy. That means the income of one sector will be the expenditure of the other sector. Likewise, the expenditure of the one sector will be the income of another sector. That's why we can say these two sectors are interdependent. Children, let's move to discuss about the different methods to calculate national income of a country. What is national income? That you have learned since the beginning of this lesson. That is the money value of all final goods and services produced in a country during a financial year. That is national income. So, there are different methods to calculate national income. The Central Statistics Office is a governmental agency in India. They are calculating the national income of our country. Who is that? The Central Statistics Office. It's a governmental agency. They are calculating the national income of our country. So, what are the different methods to calculate national income? They are income method, product method or value added method. It is also known as output method. So, there are three different names for this product method. Product method, value added method and also output method. The third one is expenditure method. So, these are the three methods for calculating national income. Which are they? Income method, product method, expenditure method. Now, let's discuss about each and every method in detail. Children, before studying about the three methods of calculating national income, you should have some basic awareness or you should have some knowledge about the keywords that having great significance in national income accounting. Besides, I'll give you some abbreviations and expansions which are very important while studying this topic. So, first of all, we can just revise the definition of national income once again. National income is the money value of all final goods and services produced in a country in a financial year. When we convert this definition into formula, it will be like this. NI equal to NVAFC plus NFIA. What is this? NI stands for national income. That means national income is equal to NVAFC. NVAFC means the net value added at factor cost plus NFIA. That means the full form of NFIA is net factor income from abroad. So these are the formula of national income. That is NI equal to NVAFC plus NFIA. What is this NFIA? NFIA is the income earned by the normal resident of a country from the rest of the world in the form of wages, salaries, interest, and rent, etc. That is NFIA, net income, net factor income from abroad. Then what is NVAFC? Before that, you have to know about GDP and factor cost. What is GDP? GDP, the full form of GDP is Gross Domestic Product. Gross domestic product is the money value of all final goods and services produced in the domestic territory. Keep in mind, domestic territory of a country in a year. That is, GDP is the money value of all final goods and services produced in the domestic territory of a country in the year. That means in GDP, we are considering only the money value of all goods and services produced inside the domestic economy. That is, we are not considering the income from abroad. In GDP, we are not considering NFIA. That is, net income from abroad is not calculating in GDP. And who is a normal resident? Normal residents are those individuals and institutions who normally reside in a country for more than 1 year and whose center of economic interest lies in the country. That is normal resident of a country. In India, the most highlighted measure of national income has been the GDP at factor cost. The Central Statistics Office of the it's a government agency of India has been reporting the GDP at factor cost and at a market price. The GDP of any nation represents the sum total of gross value added GVA. Gross value added in all the sectors of the economy during a year after adjusting tax and subsidies. Gross value added or GVA is the value of total output produced in the economy less the value of intermediate consumption. The value of intermediate consumption means the output which is used in production and at the same time it is not used in final consumption. That includes intermediate consumption. So this gross value GVA is the value of total output produced in the economy less the value of intermediate consumption. So the GDP of any nation includes the sum total of this GVA. GVA of all sectors of the economy during a year after adjusting tax and subsidies. Subsidies are sum of money granted by the state or public body to help an industry or business to keep the price of a commodity or service low. Now you have to understand the difference between factor cost, basic price and market price. We can discuss about market price first. Market price represents the price of goods and services inclusive of net indirect taxes. Net indirect tax equal to indirect tax minus subsidies. That is, the market price includes the price of goods and services and also it includes the indirect tax. So it implies the market price involved the indirect tax. So what is net indirect tax? Net indirect tax is the difference between indirect tax and subsidies. What is indirect tax? Indirect tax imposed by the government on production, sales or imports of goods. All these are categorized in indirect tax. Excise duty, sales tax, customs duty, all these are examples for indirect tax. The GST also an example of indirect tax. So this indirect tax imposed by the government indirectly to the customers because they levied this tax upon goods and services before they reach the customer, who ultimately pays the indirect tax as a part of market price of the goods or services purchased. Then what are subsidies? Subsidies are the transfer of money from the government to an entity. It leads to the fall in the price of a product. The objective of subsidy is to boost the welfare of the society. It is a part of non-planned expenditure of the government. So subsidies are provided by the state or central government to the producers to enhance the production. So actually it's a monetary help to the producers in the form of subsidies. So these subsidies helps to reduce the price of goods in the market. So ultimately the consumers will get the benefit. Children, next let's learn factor cost and market price. There are 4 factors of production, right? So the factor cost includes the payment for these 4 factors of production, and it does not include any tax. In order to arrive at the market prices, we have to add to the factor cost the total indirect tax and less the total subsidies. That means factor cost includes the subsidies, but at the same time it excludes the indirect tax paid to the government. The valuation of national product at factor cost is a measure of the total output earned by the factors of production for their contribution towards the final output. But the market price is the final cost at which the manufacturer sells the goods to the customers. This market price includes all the applicable taxes. It also includes the cost of production in the form of wages, rent, interest, input prices, etc. In order to arrive at GDP, we need to add net product taxes to gross value at basic prices. That means factor cost plus net production taxes equal to gross value at basic prices. And this basic prices plus net production taxes minus product subsidies, we will get market prices. So children, these are the main points that you have to understand before studying the calculation of national income through different 3 methods. The first method for calculating national income is product method or value added method. As per this product method, the national income calculating by adding value to a product at every stages of its production. The following example will make you more clear. Suppose there are 2 producers in the economy. One is farmer and the other is baker. The farmer produces wheat from his field and he sells his wheat to the baker. By using this wheat, the baker produces bread. For producing the wheat, the farmer requires only human labor as input, and he sells a part of wheat to the baker. The baker do not need any other raw material besides wheat to produce his bread. In a year, the total value of wheat produced by the farmer was worth of rupees 100. And out of this 100 rupees worth of wheat, he sold only rupees 50 worth of wheat to the baker. And by using this rupees 50 worth of wheat, the baker produced rupees 200 worth of bread. So the net contribution made by the baker, that is 200 minus rupees 50, that is rupees 150. That is the net contribution of baker. So the aggregate value of goods produced by this economy is rupees 100, that is net contribution made by the farmer, plus rupees 150, that is the net contribution by the baker. So total rupees 250 will be coming. That is they are adding the value to a product at every stages of its production. So this is the way the product, as per product method, they are calculating national income. That is, as per this product method, national income calculating by adding the value to a product at every stages of its production. Now let's see the steps of calculating value added method for calculating national income, or how we are calculating national income. What are the steps of different steps of calculating national income through value added method? By value added, we mean the money value of final products produced by the normal resident in the domestic territory of a country. Who is a normal resident? A normal resident is an individual or an institution who resides in a country more than 1 year. That is, normal resident. So the value added, we mean the money value of final products produced by a normal resident in the domestic territory of the country. It is the difference between value of output and the intermediate cost. Thus, the value added is equal to value of output minus intermediate consumption. This method is based on the production of the country in a year. The following steps can be enumerated to explain this method. First of all, we should identify the production unit and classify them into three economic sectors, that is primary, secondary and tertiary sector. Then we estimate the money value of total production in each and every unit. Then we will get a gross value of output, GVO. GVO means gross value of output. Then thirdly, we calculate the IC, that means intermediate consumption in every unit, and deduct this intermediate consumption from VO, that is value of output, and we will obtain the total value add of that product. And after that, after summing of all these, we will get the value add of all units. We will get GVAMP, that is the gross value added at market price. So we calculate the third step is we calculate the intermediate consumption of every unit, and we will reduce that intermediate consumption from this value of output. Then we will get value added of all unit. Then after summing all these, we will get the value added of all the unit. We will get that is GVAMP, gross value added at market price, or GDPMP, that means gross domestic product at market price. Next, they will deduct CFC and NIT, that means that depreciation and net indirect tax from this gross value. Then they will get net value added of factor price. Finally, they have to add NFIA, that is net factor income from abroad, to this net value. Then finally they will get the national income of the country. This is how they are calculating national income through value added method. Then the next method is income method for calculating national income. According to this method, the factor income have to be estimated, that is income from 4 factors. And then after adding the total factor income generated in the domestic territory, we will get domestic income. The domestic income is then has to be added to NFIA, that is net factor income from abroad. And then we will get national income. For this, first step is to identify and classify the different categories. That is, firstly, the factor income have to be identified and then classified into different categories, that is CE, OS and MISC. CE means compensation of employees, that include wages, salaries, etc. OS means that it includes the rent, interest and profit, etc. OS, operating surplus, include rent, interest, profit, etc. And MISC, that mixed income, that is income from self-employed, such things. So they have to identify and classify these categories first. Then they will add the total factor income generated in the domestic territory plus this CE, OS, MISC, they will calculate all together. Then they will get NVAFC, that is domestic income of the country. Finally, they will add this domestic income to the net factor income from abroad. Then they will get the national income of a country. This is the income method of calculating national income of the country. That is the second method. First method is product or value added method. It is also known as output method. The second one is income method. The third and final method for calculating national income is expenditure method. According to this method, national income is evaluated by estimating the final expenditure incurred by different economic units, that is household, government and enterprises. What are the different steps they are following to calculate this method? Through this method, first they are categorizing the sector into 4 components. They are private final consumption expenditure, government final consumption expenditure, gross domestic capital formation and net export. So they are classifying the sector into 4. Then they estimate the above four components of final expenditure incurred in the domestic territory in an year, and all the four components they will get a gross domestic product at a market price, that is GDP-MP. Then they will deduct the CFC and NIT, that is depreciation and net indirect tax, from this gross domestic product. They will get the net domestic income. The NDPFC means the net domestic income, that is net domestic product at a market price. This NDPFC, that is this net domestic income, exclude depreciation and net indirect tax. That is why they are deducting from gross domestic product at a market price. Finally, they are adding NFIA. What is that? The net factor income from abroad to this national net domestic income. So they will get the national income of a country. This is the expenditure method for calculating national income. So children, these are all about the three different methods for calculating national income. Which are they? Product or value added method, income method, and expenditure method. Children, for your reference, I have given the abbreviations and expansions of different terms which is used in this chapter. It's very important for you, so you learn these abbreviations and expansions thoroughly. Okay? So we can conclude this session now. Watch the lecture video again, and URL also, write down the notes and send the answers for the test questions. Okay children? Stay safe, stay happy. Thank you.